Assalamualaikum warahmatullahi wabarakatuh. Bismillahirrahmanirrahim. In the name of Allah, the most gracious and the most merciful. Good afternoon, everyone. First of all, I would like to say thanks to Allah Subhanahu wa Ta'ala and Mr. Fauzan as a lecturer of Tax Accounting Class who given us chance to conduct presentation for this meeting. Before we begin the presentation, I would like to introduce of group 2 member. First is me, Nurul Fadilah, as a moderator. Second is Dinda Putri Novanti. Third is Miftahul Jannah. And the last is Mutiara Izzati Diva. Today, we're gonna present about fixed asset. So, without any further ado, let's begin the presentation. For the first material will be presented by me. The first point is recognition of fixed asset by accounting. Based on PSAK number 16 revision of 2007 states that fixed assets are tangible assets acquired in ready-made or by first bill used in the company's operation, not intended to be sold in the framework of the company's normal activities and have a useful life more than 1 year. And the second point is recognition of fixed asset by tax. The first is based on Article 9, Paragraph 2 of the Income Tax Law. Recognition or expenditure made to obtain fixed asset in an expense that cannot be charged at once, but this expense must then be capitalized and then charged through depreciation or amortization. Second is based on Article 10, Paragraph 1, 2, 3, 4, 5, and 6 of the Income Tax Law. Set the provision regarding the values allowed or the transfer of its asset. We can use two values. There are market value or book value. A place value according to fair value or market price too. The first is acquisition affected by special relationship, exchange property, smelting in the framework of liquidation of mergers, smelting, expansion, splitting, or taking business, unless determined by the Minister of Finance, and transfer other than in the form of religious donation that are mandatory to institution, formed or authorized by the government, or grants to families in a strict lineage of in degree, religious bodies, educational bodies, social bodies, in accordance with the provision of the Minister of Finance. And last is transfer in lieu of shares or capital participation. The value according to the remaining book value of the party making the transfer or the value determined by the Director General of Taxes. 4. Diversion in the form of mandatory religious donation to institutions established or authorized by the government, or grants to families in a strict line of 1 degree, religious bodies, educational bodies, social institutions in accordance with the provision of Minister of Finance. And the acquisition value is calculated on an average or by prioritizing inventory acquired first or FIFO for acquisition of inventory and calculation of cost of goods sold. And the last is based on Article 11, Paragraph 8 and 9 of Income Tax Law. For general transfer, the first is the residual value is recognized as a loss, and the sales value or insurance replacement value is recognized as income. And the last is if the insurance replacement value is known in the future, the recording of losses and income can be done in the future based on the permission of the Director General of Taxes. And the next point is the useful life. The useful life based on accounting is period an asset is expected to be used by the company, or the number of production or similar units expected to be obtained from asset by an enterprise and is subject to management's estimates. And the useful life based on tax is the useful life is determined by law according to the group of fixed asset determined by the decision of Minister of Finance and the delegation and the obligation to comply with the tax provision. And the next slide is gonna be explained by Dinda Putri Novanti.
Okay, I will continue the presentation. Next, about the depreciation. First, commercial accounting, straight line method, decrease balance method, method of number of working hours, and method of number of production units. Second, fiscal accounting based on PPX law, straight line method, and decrease balance method. Okay, next, this is the depreciation rates according to Article 11, Paragraph 6 of the Income Tax Law. There are two depreciation rates. First, straight line method, and the second, the decrease balance method. Straight line method is the method used to calculate depreciation carried out in equal parts over the specified useful life for the price. And the decrease balance method which is the method used to calculate depreciation in decreasing parts by applying a depreciation rate on the remaining book value at the remaining book value at the end of the useful life must be depreciated at once. For example, PTA has fixed asset in the form of a car purchased on January 1, 2017 for 200 million. Management estimate the useful life of the car to be 4 years with no residual value. And the question, A. Journalize the depreciation transactions for 2017. B. Calculate the temporary difference between commercial and fiscal. And C. Compute the resulting deferred tax asset or liability in the journal entry. And the answer is A. Journal on Depreciation 2017. Depreciation expense 50 million in debit and accumulated depreciation 50 million in credit. For B. Temporary difference, commercial depreciation 50 million, fiscal depreciation 25% multiply 50 million equal to 25 million. And temporary difference is 25 million. And C, because the accounting book value bigger than fiscal book value, there will be a deferred tax asset of 25 million multiplied 25% equal to 6,250,000. And Journal of Vehicle deferred tax of the current year, deferred tax asset is 6,250,000 in debit, and deferred tax benefit 6,250,000 in credit. Next will be present by Chita.
Okay, I will continue the presentation. Depreciation according to Taxation Article 11, Paragraph 4. With the agreement of the Director General of Taxes, taxpayers are allowed to make depreciation starting in the month in which the property is used to obtain, collect, and maintain income, or in the month in which the property in question begins to produce. Example of PTB who is engaged in plantation of a tractor in 2013. The plantation began harvesting at the end of 2014. With the approval of the Director General of Taxes, depreciation of the tractor can be done starting from the 2014 tax year. Depreciation according to Taxation Article 11, Paragraph 5. If the taxpayer performs a revaluation of tangible asset based on the provision as referred to in Article 19, the basis for depreciation is the value after the revaluation of the asset has been carried out. Problem example, PTC started its operational activities in 2010. During 2010, PT Arjuna posted a profit before tax of 300 million rupiah. The assumption of the magnitude of the applicable tax rate is 25%. It is also assumed that there is no permanent difference. And for the answer, PTC has taxable profit or fiscal profit for 2010 amounting to 240 million with the following calculation. Profit before tax is 300 million. For permanent difference is 0, so the profit recognized tax is 300 million. And for temporary difference, depreciation of fixed asset is 60 million, so the taxable profit or fiscal profit is 240 million. Tax on taxable profit is 240 million times 25% is 60 million. And for the journal, a temporary difference of 60 million creates a deferred tax liability of 15 million. So, in debit, current income tax expense 60 million, and in credit, income tax debt 60 million, and deferred tax expense is 15 million in debit, and deferred tax liability 15 million in credit. And this is PTC partial income statement for the year ended 31st December 2010. Profit before tax is 300 million. For income tax expense, there is current tax 60 million and deferred tax 15 million. So the net profit is 225 million. Additional useful time. If there is a sufficient material expenditure and can extend the useful life of fixed asset or provide economics benefit in the future, then according to the accounting treatment, the expenditure must be added to the book value of fixed asset concerned. Then this amount will be depreciated in accordance with the period of benefit that has been revised. According to the tax treatment, the expenditure must be depreciated separately from the old property. In other words, as if the expenditure is treated as a purchase of new property and with a new benefit period to begin, the useful period in accordance with PMK 96/PMK 3/2009, so that the period of loading depreciation will be longer. Example: a car was purchased on December 6, 2009 with an acquisition price of 100 million and is estimated to have a 10-year useful life ending December 6, 2019. To extend its useful life, on October 20, 2014, the company issued 20 million as a purchase fee on some new parts. With this additional capital expenditure, it is estimated that the economic life of the vehicle will increase by 3 years and its useful life will end on December 6, 2022. The vehicle is depreciated using the straight line method. Depreciation expense calculation according to accounting. For acquisition price is 100 million and accumulated depreciation is 49,167,000 rupees, and for book value is 50,833,000, and for capital expenditure is 20 million. So the acquisition price after adjusted is 70,833,000. For depreciation expense in 2014 is 9,793,807 rupees, and for depreciation expense in 2015 is 8,762,845 rupees. Next is calculation of depreciation expense by tax. For depreciation expense in 2014, 12.5% times 100 million plus 12.5% times 3 per 12 times 20 million is 12.5 million plus 625,000 rupees equals 13,125,000. For depreciation expense in 2015, 12.5% times 100 million plus 12.5% times 20 million equals 12.5 million plus 2.5 million equals 15 millions. For the next presentation will be presented by Mutiara Izzati Diva.
Acquisition of grant donation or the placement of shares. In accordance with Article 4, Paragraph 3 of PPH Law Number 36 of 2008, which is excluded from tax objects including first, assistance of or donations received by religious institution established or authorized by the government, and thus received by entitled recipients of donation whose provisions are regulated with or under government regulations. Grant assets received by blood families in a 1-degree straight line, religious bodies, educational bodies, social bodies including foundations, cooperative or private persons running micro and small business, whose provisions are regulated with or based on PMK, as long as there is no relationship with the business, employment, ownership, or ownership among the parties concerned. And the third, property received by the body as a substitute for shares or a substitute for capital participation. Sale or transfer of tangible property. Article 6, Paragraph 1, letter D of PPH Law Number 36 of 2008. Loss due to the sale or transfer of property on and used in the company, or on and used in the company or on to earn, charge, and maintain income deductible from gross income. And for Article 4, Paragraph 1, letter D, number 2 of PPH Law Number 36 of 2008, it says, if VP sells property at a market price that is higher than the remaining value of this book, or higher than the price or acquisition value, then the difference in price is considered a profit and is the object of PPH. Exchange of tangible property. On August 5, 2014, the company exchanged an X-car at book on December 10, 2012 for a Y car. The acquisition price of X-car was 135 million, while the acquisition price of Y car was 207 million. The depreciation method used is a straight line method and with a useful life of 10 years, and amount of losses according to accounting and by a tax, it have the same value. Acquisition price are 135 million and accumulated depreciation is 28 and 125,000, and the book value is 106,875,000, and market price of all asset is 90 million, and the sales loss is 60,875,000. And for the journal, on December, at debit is our vehicle new by 207 million. The VAT is 20 million and 700,000. Accumulated depreciation vehicle all 28 million and 125,000. Asset exchange loss is 60 million and 875,000. And for credit or vehicle all is 135 million, and VAT Article 6 15D 9 million, and for cash is 128 million and 700,000. So that's all for our presentation. Sorry for our mistake. Assalamualaikum warahmatullahi wabarakatuh.